Adroit Capital. Ready?
Yep.
15 minutes starting now.
Good afternoon, and thank you for allowing Adroit Capital to present to you the potential acquisition analysis of 619 West 54th Street. I'm Kelly Nelson, and this is my team, Jake, Evan, Mauricio, JC, and Vanessa. To start off, I'd just like to give a brief overview and also hit on some key market data points. Steinbrenner Safe Harbor's main goal is to accommodate ISTP's financial requirements for their funding. And Steinbrenner has come forward with what seems like a lucrative business opportunity to invest in 619 West 54th Street. They see the opportunity to increase rents to market, as well as fill up existing vacancies. In addition, appeal to lab use tenants. So Steinbrenner is a great general partner to work with. They are well recognized in New York. They are a full service firm. In addition, they invest in core assets that align very well with ISTP's requirements. These are the parameters for ISTP, and we are going to refer to this for the remainder of the presentation. Overall, we propose that we move forward with this acquisition and present to Mary Pope due to our levered net IRR of 9.6%. In addition, we see a strong demand for the life science industries. There's big potential for market rent growth. And in addition, Steinbrenner is a great general partner to work with. They are known for getting deals done and will present future deals in the future. Regarding some key market points, data points, Manhattan population has been increasing and is expected to continue to increase in the future, as well as employment. Sorry, this is clicking weird. So the subject property is located in Manhattan, specifically in Midtown in the West Side neighborhood. Q3 2016 data has shown that leasing activity has been the third strongest in the past 10 years. In addition, 92% of this leasing activity can be attributed to Midtown, and with vacancy expected to decrease and rents expected to increase, we see a big push towards West Side. Overall, the market looks like it is entering into early stages of hypersupply. However, we feel that this property hedges this risk greatly, and Vanessa is going to go into more detail.
Thanks, Kelly. So one of our favorite portions of this deal is that the vacancies we do have are zoned for life science tenants. A quick quote from JLL is that with a well-funded, lively tenant base, a shortage of suitable properties, and rising rents, we have all the requirements for a strong return on investment. In New York, we have private clients, incubators, and well-known public universities. In these centers house our clients. We can see the Alexandria Center coming in at 1 million square feet, but 100% leased, and other centers generating millions of dollars from government money to build out in the life science market. The life science industry is heavily dependent upon synergies, and this comes from concentration and proximity to each other in the New York market. Competitors include Boston and San Francisco, coming in at about 20 million square feet. However, New York City is first in jobs with double the workforce that either of the top two cities have. The city has began to realize this risk and started to mitigate it by offering more supply and incentives. December 13th, Mayor Bill de Blasio came out with a $500 million life science initiative. And in this 10-point plan, his two key points that relate to the real estate life science industry is explicitly stating that life science can be now commercially zoned, and that $300 million in tax incentives to sort of mitigate the shortage of supply due to the space crisis. This 10-point plan hopes to increase the economy by a few billion, create high-paying jobs, as well as generate about $7 billion in private investments. These do include risks, being that tenants are looking for Class B space, like our property, while developers are concentrating on Class A. Another risk is that these firms could be incubated in New York City with government money, but look for space to expand and can't find it, so move to Boston or San Francisco. Another risk is that New York City is heavily dependent on government money, meaning that for every $1 they receive in federal funding, they can only generate about 6 cents in VC money. While you look in Massachusetts, they're receiving $1.32. This is why we also argue that while the rest of New York is in hyper supply, our industry, which is very good for our client, is in the early stages of expansion, and I'll now pass it to Vanessa to talk about our clients.
Thank you, JC. So looking at all of our tenants, we believe that realistically all of our tenants will be renewing their leases. So the Arcade Bridal relocated from a garment district, and we have the Roosevelt Surgery Center, which is a private clinic for individuals, and both of these tenants are looking for a space that allows them access to a young, affluent residential community population. And the John Jay College have rent spaces in buildings near our property. And we have the Rogerson Institute as well as the New York Stem Cell Foundation, which both have been very successful life science institutes over the past 10 years. So looking at the potential tenant to fill our vacancy in life science spaces, we have the life science lab as well as the medical office space. So we look at medical office because we are able to gain a higher rent per square foot, as well as it's very compatible to the life science lab. There are very promising medical university near our area, and whenever they're looking to expand their lab space, they can look into us as potential supply in the future. So after our 5-year hold, we will be selling our properties, and these are the list of potential investors that will purchase our property. So these lists of real estate companies are either holding or are interested in buying lab science spaces. And they have a bias toward the long-term core asset, which is our property, as well as a steady income generation year after year provided by our tenant over price appreciation in the property value. And now, Evan will talk to you all more about the financial analysis.
Thank you. So our first step was to kind of analyze the situation. We have Mary Pope, who's a risk-adverse investor who has a pessimistic outlook of the future. And on the other hand, we have Steinbrenner, who's presented us a great deal that we would like to get done. So our solution is to utilize conservative investment approaches and look at downside scenarios and what's the best way to mitigate all those risks and get returns that fit with ISTP standards. The first thing we looked at was the $175 million purchase price. We wanted to see if this was a fair and reasonable price, and compared to transaction comps in the area, we believe it is. Because of the heavy amount of price and the low cap, we think that a shorter hold period will probably do us well. We also want to see how this deal fits with the current representative deal set of ISTP. Here, again, we think it fits pretty well. If we look at the LA office, we think it has a similar strategy and hold period for what we're looking for. And now looking at our hold period analysis, we looked at hold periods below 5 years, above 5 years, but ultimately we wanted the 5-year hold. We're able to pay out our debt with no extension fees, and we're also able to reach a project stabilization for sale. For our terminal cap rate, we also use a conservative approach to keep in line with Mary Pope's kind of pessimistic outlook. If she's wrong and the market is better, we can only get better returns. Upon acquisition, taxes are going to be a thing. With the base and optimistic scenarios, when we fill up the vacancies and we're reaching market rents, we think there's higher market value and we'll get higher tax values as a result. And with the downside scenarios, when we can't lease up vacancies, we're not reaching market rents, we're going to be paying less in taxes. Ultimately, what we want to do is look at Steinbrenner's business plan and come up with financial scenarios in which they achieve, fail to achieve, or outperform their current business plan. And what we really want to focus on is that downside and how we can avoid it. As the middleman, what we can help with is figuring out which debt option would be best to mitigate the downside risk. We believe the LifeCo option is the best with the lower LTV and a fixed rate moving into the future. I'll now pass it off to Mauricio to talk about the base case scenario.
Thanks, Evan. So under base case scenario, we have the current tenants all renewing, as well as all of the vacant spots in the building also getting leased up. The 10th floor and the 3rd floor will be leased up by lab tenants, and the second half of the 1st floor retail will be leased up by another dealership. Now, with all of these assumptions, allow us to reach ISDP's target IRR return of 7 to 11% by having a 9.6% return. Now, to get these returns, we conducted a waterfall based on the splits as well as the hurdles highlighted in the case. We also factored in the fees that were going to be paid to Steinbrenner, as well as any future funding equity. We then ran a sensitivity analysis on the project return, as well as the reversion value based on a 4.5% cap. We then compared these outputs to the outputs that would be acquired through the debt fund and unlevered. And we noticed the debt fund outperformed LifeCo, but before we made a final conclusion, we wanted to explore more scenarios. Going over our realistic upside scenario, this is where RK Bridal and John Jay do not renew, but instead are replaced by 2 other lab tenants. Similar to the basic scenario, we have that the 10th floor and the 3rd floor also get replaced by lab tenants, and that the second half of the 1st floor retail will be leased up by a dealership. Now, why do we want 4 lab tenants? Because according to our research, the lab tenants perform the best, and they're in high demand of this space. And assuming all these assumptions go into place, the return is significantly higher than the base case scenario, coming in at 15.7% for ISTP. We then again conducted a waterfall, and then took a 4.25% cap and conducted our sensitivity analysis. And the only difference in structure between this one and the base case is that since we have significantly higher cash flows, we do not need any future funding. Again, we compared it to the outputs that would be derived from the debt fund and unlevered. And again, debt fund outperformed LifeCo, but we wanted to go over specifically our downside scenarios before making a final conclusion. Now I'll pass it over to Jake so he can talk to you about our downside scenarios.
All right, so we've looked at the base case scenario and upside, but now we have to look at when things start to go south, market conditions change, as well as different leasing activity. So we want to run a realistic downside, which is more of a conservative estimate, and then we have more of an all heck breaks loose type scenario that we'll go into later. In this situation, we're only able to get 1 lab tenant in, and we have significantly lower rents for the office when we lease those up, and the retail will be filled with a dealership later on. Again, lesser rents. We're still able to achieve a 5% levered IRR on the deal, and ISTP is hitting at a 4.7. Looking at the downside scenario, we do look at exiting at a 4.75 cap, and this still gives us our returns, but as we can see, if things start to go further south, we'll get closer to that break-even point, so right around 5.35% cap rate, we would hit that break-even point. What's really important to see now is where the debt fund now starts hemorrhaging our returns. As you can see, the LIBOR assumptions in that page earlier, those include the 250 bip spread that's included in the case. And as those rates increase along with the exit fees, we do see those negative outputs. We now wanted to run the all heck breaks scenario. And this is, again, having even significantly lower rents than we had before. We also factored in additional downtime for lease up from the renewals, from the vacates and also just the empty tenants to begin with. Additionally, adding in some more TIs. This is close to our break-even point, so we see a 1.2% leverage for ISTP. We ran this scenario at a 4.75 cap. Again, this might be a little generous for this scenario, but we can see that that's our break-even point, because once we start getting closer to the 5 and 5.25, that's when we start seeing negative returns. Again, we see the debt fund, when we're not having enough sufficient cash flows from the rental items on the top, we do start seeing those negative returns, and again, pushing why we're going to go with the LifeCo insurance option. We're able to still see small positive returns when the debt fund will be hitting a negative return. So here's just an outcome summary of everything for the base scenarios. Then we want to go even one step further. So JC really hit on that the government is really trying to back the life sciences and lab space move in New York City. So we want to run a scenario where each lab tenant we bring in, so that's 1 in the downside, all the way up to 4 in the upside, we would get $375,000 per year per tenant. So that juices up our returns about 1% on the ISTP side per scenario. Now I'd like to pass it back off to Evan to finish us up.
All right. So assuming we go forward with the acquisition, this is just a generic timeline highlighting key important dates between our 5 and 7 year hold. And lastly, I'd like to summarize our highlights of the recommendation. We believe that the downside scenarios are exaggerated and very unlikely to happen, which leaves us with a bunch of potential upside. We believe that Steinbrenner will fill the vacant space with labs. We think that Mary Pope will enjoy that we use a conservative analysis approach. We believe that the LifeCo option does hedge against downside risks, and we believe that showing our analysis of tax incentives will prove to ITSP that there's potential upsides with minimal potential downsides, and it overall fits with ISTP investment parameters. And finally, with the qualitative benefits to all parties, with ISTP, they're able to secure their first deal of the year. Safe harbor will remain Safe Harbor will keep ISTP as a premier client, and Steinbrenner will find a great capital partner to execute its business plan. And with that, we are open to questions.
Questions?
How did you think about the fees for Steinbrenner?
Sure.
So when you did some of those sensitivity analysis, I think slide 47, some of the downside and non-performance scenarios.
Yeah. Let me go to, all right, here's our waterfall. So when looking at our waterfall, we wanted to not only include the asset management fee and the property management fee in Steinbrenner's returns. So those are taken out of just the basic, line items, the operating expenses section of the pro forma. So those are sort of siphoned aside. But then you also have to factor in that ISTP/us have to put in those fees on the construction management as well as the leasing side. So I took those out as a sort of less fees. That's the negative distribution. So some of the negatives might be confusing, but just that's money that they had to pay out that would then be returned up into the Steinbrenner cash flows. And speaking from our first scenario, our first round, in reality that might be adjusted per fund because Steinbrenner would have different areas where he might be having his the leasing side of the business and construction management, but we just included all of those in this scenario. But we wanted to capture that because that really juices up Steinbrenner's returns, and at the end of the day, his returns, especially in the unlevered scenarios, are very low. So we wanted to show that.
Sorry, what is the structure that you're proposing? And are you saying you're going to go back to them and changing it, or are you saying?
No, so we took the side of keeping the 6%, 10%, and the same hurdles that were provided in the case. We looked at it as we were sort of having our backs against the walls and that we haven't done a deal this year, and we haven't gotten any deal flow from Steinbrenner per the case, and we want to use them as a partner going forward and really want to make a deal happen. So we were able to give up some of those fee structures that maybe aren't as advantageous right now, but to see when deals come in the future and fruition that we'll be able to, extend and be a little bit more aggressive.
So when you're doing the analysis on the retail space, you're looking to possibly convert some of the retail space to non-retail use?
So,
Or did you look at other retailers, or it's just?
yeah, so primarily based on the zoning in New York, this block that we're in is pretty much only areas zoned in Manhattan for dealership use. So we really felt that with the demand, and JC, if you want to speak on more about this, there's a lot of demand for dealerships in that area. So in our extreme worst case scenario, what we did is we factored in, so this vacant retail at the bottom, we said, all right, we're not able to get a dealership tenant because something in the market's going on, but we're going to backfill it with just a normal retailer, and this isn't necessarily the best spot for retail, and then they're commanding significantly lower rents as the dealer is paying a premium because there's only certain areas in New York where a dealer can actually be.
Yes, exactly. If you look at 11th Avenue in New York, it's sort of known in that area to have the luxury car dealerships. In that area include McLaren, Subaru, Mercedes-Benz. It's just that area, that's where the hub is. A lot of retail tenants tend to cluster together, and we believe that space, highest and best use, in a sense, on the bottom floor, is great for dealerships.
You said all the tenants were renewing in your base case.
For the base case, yes.
So walk us through maybe some of the Bruce had asked that from the other team to talk through the rents, but why don't you just describe downtime, concessions, and how you do that, because the likelihood of all of these tenants renewing is, I would love for it to happen, but it usually doesn't. And so how did you account for that in your underwriting?
Let me just go back to that slide. Base case. Okay, so we looked at when the tenants would renew, we would mark their rents to market, and that's based on just looking at the rent roll and what it would be, and then adjusting based on what what it was at that time for the market. We used pretty general TI assumptions that were given in the case based on comps, so we didn't go anything too outside of the box. What we did do, especially with the lab space, because that's a pretty intense build out because there's a lot of specificities that tenants are wanting, we added a 1-year sort of bake of until that tenant would move in. And we also gave them 12 months of concessions. We factored that into our models. But we gave out that 1 year between leasing up and finding a tenant and also building out that spot. So that was our main assumption for the lab spaces. And if we go into other scenarios, we have, whenever the renewals would happen, we would factor in 6 months to a year, depending on the scenarios of downtime. And then again, the concessions, we have 12 months for a lab tenant, I believe 6 to 8 months for normal office, and 4 to 5 months for retail.
Would you prefer not to have a renewal because you had a higher rent for the new tenant?
Sorry, say that again?
Would you prefer not to have, your upside doesn't have 100% renewal, so you actually did better without the renewal?
Yes.
That's because
True.
the tenants that are not renewing were tenants that have lower rents than what we might achieve if everyone was lab tenants. So this is kind of like the high end, like this is the max potential, and this would be the best scenario. If it happens, if it doesn't happen, we still look at our base case scenario. So in between that range, the more lab tenants, the better. So this was kind of just
Are
the
those
top
rents
end.
untrended? Are they the rents at that point in time? So is the floor 6, is that $77 today growing, or is that $77
When
in
they renew.
2021?
It is when they renew.
It's when they renew.
When they renew.
Yeah.
Okay, so that's why you see differences there.
Mhm.
And then did you guys think through, like, when you are converting it to lab, the infrastructure of the actual building and the systems, because it's not just $300 to build out the space, as you know, there's cooling and HVAC and hoods, and there's a lot of other things that uninterrupted power systems that you need to have. So how did you guys view that capital in your analysis, if at all?
With the TIs, we factored an extra few $100,000 essentially in that expense line item, and then again we had that levered in a sense, but we factored in a few $100,000 per year, and that would take on sort of the extra capex build.
Yes.
Is
And
there
the last
anything else on the physical side that you're doing upfront to attract
Yes,
these tenants?
Yes, in the last sale, it was about, I think, $8 million that the last firm had put in terms of tenant improvements. And so after that sale, we were the next firm to sort of step in, so we kind of recouped all the benefits and the work they had done.
The building improvements, not necessarily tenant improvements.
Yeah, so building improvements.
Because you guys didn't have any other building or other capex necessarily, just a higher TI with the tenants?
Yeah, we have it baked into the analysis, but that's something that we'd look at down the road. We haven't, in our analysis here though, we haven't said, all right, we're gonna have to add in other heating and cooling and things like that.
And that's another point. We kind of wanted to stay in the Class B range simply because that's what the market is asking for. If they wanted Class A, they could easily go to the Alexandria Center or any of these other like Lilly type tenants type buildings. And so we were trying to stick within the Class B.
And I'll add one more point to that. We, underwrote these tax incentives at, I feel, a conservative estimate. I don't know enough about New York City's tax policies and things like that, but after speaking and doing some more digging, like eventually I think we're in an opportunity zone, so that we would get even more tax benefit, so we can use that type of funding, from that, I guess, saving cost to use to build out for those lab tenants.
I was on a committee with this biotech and pharma tenants and whatever.
They do those things.
Yes, you're able to recoup the prior owners, HVAC and all that good sort of stuff. But my theory is whether you're Class B, Class A tenants in that market, if somebody's doing an NIH research project and that refrigerator can't go off with all the little, all the experiments, doesn't matter what grade tenant. That refrigerator, that HVAC has to be on it. So I'm not quite sure your 100,000 makes sense. My question is, and it goes for everybody, everybody thinks the farm is going to be what the next tenants are going to be. What's your plan B? I always believe in a plan B in life.
Yeah, so our plan B is to lease it up with office. Again, we've factored in additional time. So if we look at the vacant office floor 3, so that is a scenario where we're going to try to get a lab tenant in. That doesn't work. So we're baking in an additional year of lease-up downtime, and giving them a nicer TI package, and also decreasing the rent to 35. So that is a situation where we would look at getting office, potentially medical office as another type of
And we
scenario.
also considered,
However, my experience with medical office, very often wants to be near a hospital.
Yeah.
And there's really no hospitals
Yeah.
in this neck of the woods. And you did a great job with your graph, with your chart showing what's
Yeah.
nearby.
Yeah, we put office. We thought office would be
So
the
that
best.
would be in your downside scenario.
Yes, this is a downside, and then even further downside in the all heck breaks loose scenario.
Got it, I just wanted to
and
make sure.
yeah,
what-
it's
So
all
when
focused.
When you presented to your investor, what was the range of equity requirement you told them they would need?
So let's look at the base case scenario. So we have from ISTP, we got put in 34.95 initially, and that's factoring in the fees. And then we're also going to need an additional $2.3 million of future funding of equity. That comes from the cash flow from year one, where we're under. So we have to put in additional equity to suffice and push the project forward.
But if you have an upside case, you're gonna need a lot more capital because you're putting lab tenants in. So what was the total?
The lab tenant, we were able to capture from the rental income, so we have higher TI. So we kept the TIs the same. So again, we haven't factored in some of that CapEx that would need to be put in, but we're having significantly higher rents being achieved and higher cash flow from just the rental line item and trickling that down. We have enough cash flow essentially to cover the equity portion of the TIs that would need to be done.
What was the TI for the new lab tenants?
300.
Yeah.
And you had enough cash flow to cover that?
That'll have to be the last question,
Let's go realistic downside.
the last answer.
Realistic upside. Yeah. So 10.5, factoring that down, and then we're getting this 60% funding from the debt. We have 4.9 million in the 4.9 million of NOI, and then we're still able, and then we would have to put in 8.46 million.
You have future funding coming from the lender, like a good news facility built in here, is what you're saying.
Yeah.
Okay, that's gotta be the final question.
I'm happy to go over financials with you guys later on. We underwrote this.
Okay, thank you very much.
Thank you.
Yeah.
Thank you.